Question 1. Michael has purchased a term life insurance policy with a renewable feature. After 5 years, the policy is up for renewal. What will happen to the premium when he renews his policy? A. The premium will decrease because the policy has built up savings. B. The premium will increase because Michael is older at the time of renewal. C. The premium will remain the same because the term is renewed automatically. D. The premium will decrease because renewable policies become cheaper over time. Answer. B. The premium will increase because Michael is older at the time of renewal. Explanation. In renewable term life insurance, the premium typically increases upon renewal. This is because the premium is based on the insured's age at the time of renewal and the risk of death increases with age. Since term policies do not accumulate cash value, there are no savings or reductions to offset premium increases. North Carolina regulations and general insurance principles outline that renewable policies are temporary protection contracts and premiums are adjusted based on the insured's age and current health at renewal, not on past performance or savings components. Question 2. Scenario-based. MS Johnson has a term life insurance policy with an accidental death benefit rider. She is involved in a serious car accident and as a result suffers a permanent disability. Unfortunately, she passes away due to complications from the injury 3 years later. Which of the following would her beneficiary receive? A. Only the face value of the policy, since accidental death riders do not apply after 2 years. B. The face value of the policy and an additional amount for the accidental death rider since the death was caused by the accident. C. The face value of the policy only because her death occurred more than 2 years after the accident. D. Nothing because accidental death riders only cover death within 24 hours of the accident. Answer. B. The face value of the policy and an additional amount for the accidental death rider since the death was caused by the accident. Explanation. The accidental death benefit rider provides an additional payout if the insured's death is caused directly by an accident. In this scenario, MS Johnson's death resulted from complications related to the car accident. Most accidental death riders stipulate that the insured must die within a certain period, typically 90 days of the accident, for the rider to apply, but since North Carolina does not impose an unusually restrictive time frame and MS Johnson's death was clearly linked to the accident, her beneficiary would receive both the face value of the policy and the additional benefit from the accidental death rider. Question 3. Which of the following beneficiaries cannot be changed by the policyholder without the beneficiary's consent? A. Revocable beneficiary. B. Contingent beneficiary. C. Primary beneficiary. D. Irrevocable beneficiary. Answer. D. Irrevocable beneficiary. Explanation. In life insurance, a policyholder can designate a revocable or irrevocable beneficiary. A revocable beneficiary can be changed at any time without their consent, while an irrevocable beneficiary cannot be changed unless they provide explicit consent. This legal distinction is important in protecting the rights of the beneficiary. North Carolina insurance regulations require strict adherence to the terms of beneficiary designations, especially when dealing with irrevocable beneficiaries, ensuring the policyholder cannot modify the policy to the detriment of the designated person without proper legal processes. Question 4. When applying for a term life insurance policy, which of the following would most likely result in a substandard risk classification? A. A 25-year-old applicant with no health issues but a family history of heart disease. B. A 30-year-old applicant who works as an accountant and has no medical conditions. C. A 40-year-old applicant who is a smoker and has high blood pressure. D. A 50-year-old applicant who has recently quit smoking and is in excellent health. Answer. C. A 40-year-old applicant who is a smoker and has high blood pressure. Explanation. Substandard risk classifications are given to applicants who present a higher than average risk to the insurer, often due to factors like smoking or underlying health conditions such as high blood pressure. In this case, the 40-year-old applicant has two significant risk factors: smoking and high blood pressure, which are both considered when underwriting a life insurance policy. North Carolina regulations allow insurers to assess risk based on medical factors, lifestyle choices, and age, and this individual would likely be charged a higher premium due to their health risks. Question 5. Scenario-based. Mr. Evans has a level term life insurance policy with a face value of $500,000 and a waiver of premium rider. 2 years into the policy, Mr. Evans becomes permanently disabled. What will happen to his policy now? A. The policy will terminate because he is no longer able to pay the premiums. B. The premiums will be waived and the policy will remain active with the full death benefit. C. The face value of the policy will decrease to $250,000, but no more premiums will be due. D. The premiums will continue to be paid from a loan against the policy. Answer: B. The premiums will be waived and the policy will remain active with the full death benefit. Explanation: the waiver of premium rider is designed to keep a policy in force if the policyholder becomes permanently disabled and unable to work. In this scenario, Mr. Evans' policy will remain active with the full death benefit of $500,000 and no further premiums will be required due to his disability. North Carolina insurance regulations allow for riders like this to protect policyholders during times of financial hardship, ensuring that their coverage remains in place despite being unable to make premium payments. Question 6. Which of the following is not typically a feature of annual renewable term insurance? A. Premiums increase every year based on age. B. The policy can be renewed without proof of insurability. C. Cash value accumulates over time. D. Coverage is for 1 year at a time with the option to renew. Answer: C. Cash value accumulates over time. Explanation: annual renewable term insurance provides coverage for 1 year at a time with the option to renew the policy each year without needing to prove insurability. The main disadvantage is that premiums increase annually as the policyholder ages. However, term policies like ART do not accumulate cash value, which is a feature of permanent life insurance policies. In North Carolina, term life insurance policies, including ART, are primarily designed for temporary protection without any savings or investment components. Question 7. Which of the following is not considered a mandatory provision in a term life insurance policy? A. Incontestability clause. B. Grace period. C. Entire contract clause. D. Cash surrender value. Answer: D. Cash surrender value. Explanation: term life insurance policies do not accumulate a cash surrender value as they are purely designed for temporary coverage. Mandatory provisions, such as the incontestability clause, grace period, and entire contract clause, are required by law to be included in life insurance policies to protect both the policyholder and the insurer. North Carolina regulations require these provisions to ensure fairness and transparency, but since term life insurance lacks a savings component, there is no cash surrender value associated with these policies. Question 8. Which of the following is most likely to be the primary purpose of decreasing term insurance? A. To cover a mortgage or other loan that decreases over time. B. To provide lifelong protection with a growing death benefit. C. To provide coverage that remains level for a fixed period of time. D. To build cash value while providing decreasing coverage. Answer: A. To cover a mortgage or other loan that decreases over time. Explanation: decreasing term insurance is often used to cover a debt that decreases over time, such as a mortgage. The death benefit decreases over the policy term, matching the decline in the debt obligation. This makes it an affordable option for people who want insurance that aligns with their liabilities. North Carolina's regulations recognize decreasing term policies as a way to provide protection for specific financial obligations without offering any cash value or permanent coverage options. Question 9. Scenario-based MS. Garcia has a term life insurance policy with a conversion option. After 5 years, she decides to convert her term policy to a permanent life insurance policy without providing evidence of insurability. Which of the following is most likely to happen? A. She will need to undergo a new medical exam before converting the policy. B. Her premium will remain the same as her term life policy. C. Her premium will increase based on her age at the time of conversion. D. She will lose her death benefit upon conversion. Answer: C. Her premium will increase based on her age at the time of conversion. Explanation: a conversion option allows a policyholder to convert their term life insurance policy to a permanent life insurance policy without providing evidence of insurability. However, the new premium will be based on the insured's age at the time of conversion rather than when the original term policy was purchased. North Carolina regulations allow this feature to provide flexibility to policyholders as their insurance needs change, but the cost of permanent insurance tends to be higher, especially as the policyholder ages. Question 10. Which of the following options is most accurate regarding the taxation of life insurance death benefits? A. Death benefits are always subject to federal income tax. B. Death benefits are generally tax-free, but interest earned on delayed payouts is taxable. C. Death benefits are tax-deductible for the policyholder's estate. D. Death benefits are subject to state and federal income tax if the policyholder is under age 60. Answer: B. Death benefits are generally tax-free, but interest earned on delayed payouts is taxable. Explanation: life insurance death benefits are generally not subject to federal income tax. However, if the death benefit payout is delayed and the insurer pays interest on the benefit, that interest is taxable. This tax treatment is governed by federal law and is consistent with North Carolina tax regulations, which also stipulate that death benefits themselves are typically tax-free, providing financial relief to beneficiaries without additional tax burdens. Question 11, scenario-based. Mr. Johnson owns a $200,000 whole life policy with a cash value of $50,000. If he borrows $10,000 from the policy and dies 1 year later without repaying the loan, how much will his beneficiary receive? A. $190,000. B. $200,000. C. $150,000. D. $140,000. Answer: A. $190,000. Explanation: when a policyholder borrows against the cash value of a life insurance policy, the loan amount is deducted from the death benefit if it is not repaid before the policyholder's death. In this case, Mr. Johnson's $200,000 death benefit will be reduced by the $10,000 loaned, leaving his beneficiary with $190,000. North Carolina regulations allow life insurance policyholders to take loans against their cash value, but unpaid loans reduce the death benefit. Question 12. Which of the following riders would provide additional coverage for a specific period if the insured dies in an accident? A. Accidental death benefit rider. B. Waiver of premium rider. C. Term conversion rider. D. Guaranteed insurability rider. Answer: A. Accidental death benefit rider. Explanation: an accidental death benefit rider provides an additional payout to the beneficiary if the insured dies due to an accident, typically doubling the death benefit. This rider is often added to life insurance policies to cover unforeseen accidental deaths. North Carolina insurance policies frequently offer this option, enhancing the policy's value in case of accidental death. Question 13. Which of the following best describes a grace period in a life insurance policy? A. The time during which premiums can be paid after the due date without the policy lapsing. B. The time before a policy becomes incontestable. C. The period after a policyholder has passed away for the beneficiary to file a claim. D. The time a policyholder has to convert a term policy to a permanent policy. Answer: A. The time during which premiums can be paid after the due date without the policy lapsing. Explanation: the grace period is a set time frame after the premium due date during which the policyholder can make the payment without the policy lapsing. In North Carolina, this period is typically 30 or 31 days, ensuring that coverage remains active even if a payment is missed temporarily. Question 14, scenario-based. Mrs. Thompson buys a life insurance policy and names her 2 children as primary beneficiaries, each receiving 50% of the death benefit. She later names her spouse as the contingent beneficiary. What happens if Mrs. Thompson and one of her children die simultaneously? A. The surviving child receives 50% and the spouse receives the other 50%. B. The surviving child receives 100% of the death benefit. C. The spouse receives the entire death benefit. D. The death benefit is equally divided between the spouse and the surviving child. Answer: B. The surviving child receives 100% of the death benefit. Explanation: if one of the primary beneficiaries dies, the remaining primary beneficiary receives the entire death benefit. In this case, since Mrs. Thompson's surviving child is a primary beneficiary, they will receive the full death benefit. Contingent beneficiaries only receive the benefit if no primary beneficiaries survive the insured. Question 15. Which of the following types of life insurance provides lifelong coverage and accumulates cash value? A. Term life insurance. B. Whole life insurance. C. Annual renewable term insurance. D. Decreasing term insurance. Answer: B. Whole life insurance. Explanation: whole life insurance provides lifelong coverage as long as premiums are paid, and it accumulates cash value over time. The cash value can be accessed through loans or withdrawals. In contrast, term life insurance is temporary and does not accumulate cash value. Question 16. In a life insurance policy, which of the following is not typically included in the free look provision? A. The policyholder can cancel the policy within a set number of days. B. The policyholder receives a refund of premiums paid if the policy is cancelled. C. The insurance company must approve the cancellation. D. The free look period is often 10 to 30 days, depending on state regulations. Answer: C. The insurance company must approve the cancellation. Explanation: the free look provision allows the policyholder to cancel the policy within a specific period, usually 10 to 30 days, without the insurance company's approval, receiving a full refund of any premiums paid. This provision ensures policyholders have time to review their purchase and decide whether to keep the policy. Question 17, scenario-based. Mr. Clark owns a term life insurance policy with a conversion option. The policy is about to expire, and he decides to convert it to a whole life policy. Which of the following will likely happen? A. Mr. Clark's premiums will stay the same. B. Mr. Clark's premiums will increase based on his current age. C. Mr. Clark will lose the death benefit. D. Mr. Clark will need to provide proof of insurability. Answer: B. Mr. Clark's premiums will increase based on his current age. Explanation: when converting a term life insurance policy to a whole life policy, the premiums will increase because whole life policies provide permanent coverage and cash value accumulation. The new premium is based on the insured's age at the time of conversion. Proof of insurability is not required under the conversion option. Question 18. Which of the following would be considered a settlement option in a life insurance policy? A. Lump sum payment. B. Waiver of premium. C. Dividend option. D. Paid up additions. Answer: A. Lump sum payment. Explanation: a settlement option refers to how the death benefit is paid out to the beneficiary. Common settlement options include lump sum payments, installment payments, and annuities. The other choices, waiver of premium, dividend option, and paid up additions, refer to policy features, not settlement options. Question 19. Which of the following statements about survivorship life insurance is most accurate? A. It insures two or more individuals and pays the death benefit when the first insured dies. B. It insures two or more individuals and pays the death benefit when the last insured dies. C. It is a form of term insurance that covers multiple lives. D. It provides a decreasing death benefit over time. Answer: B. It insures two or more individuals and pays the death benefit when the last insured dies. Explanation: survivorship life insurance, also known as second to die insurance, covers two or more individuals and pays the death benefit only after the last insured person dies. This type of policy is commonly used for estate planning purposes. It differs from joint life insurance, which pays upon the first death. Question 20, scenario-based. MS. Lopez has a whole life insurance policy with a cash value. After 10 years, she needs some extra funds for an emergency. What can she do to access the policy's cash value? A. She can take out a policy loan, which she must repay with interest. B. She can withdraw from the policy's face value. C. She can stop paying premiums and receive the death benefit immediately. D. She can increase the policy's death benefit by withdrawing cash value. Answer: A. She can take out a policy loan, which she must repay with interest. Explanation: whole life insurance policies accumulate cash value over time, which policyholders can access through loans or withdrawals. In this case, MS. Lopez can take out a loan against the policy's cash value, which will need to be repaid with interest. If she doesn't repay, the loan amount will be deducted from the death benefit upon her death. Question 20 on scenario-based. Mr. Davis bought a $300,000 term life insurance policy. He is diagnosed with a terminal illness and is given 6 months to live. He has heard of an accelerated death benefit rider in his policy. What could this rider allow him to do? A. Borrow up to the full face value of his policy while alive. B. Receive part of the death benefit early to help with medical expenses. C. Cancel the policy and receive a full refund of all premiums paid. D. Convert his term policy to a whole life policy with no premium increase. Answer: B. Receive part of the death benefit early to help with medical expenses. Explanation: an accelerated death benefit rider allows the insured to receive part of their death benefit early if they are diagnosed with a terminal illness. This money can be used for medical expenses, care, or other needs. The remainder of the death benefit will be paid to beneficiaries upon the insured's death. Question 22. Which of the following best defines a contingent beneficiary? A. A beneficiary who receives the death benefit if the primary beneficiary is no longer alive. B. The person who pays the policy premiums on behalf of the insured. C. The individual or entity that receives the death benefit regardless of the primary beneficiary. D. The person who controls the investment options within a variable life policy. Answer: A. A beneficiary who receives the death benefit if the primary beneficiary is no longer alive. Explanation: A contingent beneficiary is someone who will receive the death benefit if the primary beneficiary predeceases the insured or is unable to claim the death benefit. Contingent beneficiaries provide an extra layer of protection in estate planning. Question 23. What happens if a life insurance policy lapses due to non-payment of premiums, but the insured wants to reinstate the policy? A. The policy can be reinstated without any penalty or interest. B. The insured must provide evidence of insurability and pay all overdue premiums with interest. C. The policy can only be reinstated within 10 days of lapsing. D. The insured must purchase a new policy. Answer. B. The insured must provide evidence of insurability and pay all overdue premiums with interest. Explanation. Reinstating a lapsed life insurance policy typically requires the insured to provide proof of insurability and pay all back premiums plus interest. Most policies allow reinstatement within a specified period, often up to 3 years after lapse, as long as these conditions are met. Question 24. Scenario-based. Mrs. Patel has a universal life insurance policy. She decides to stop paying premiums for a few months but still wants her policy to remain active. What allows this to happen? A. The policy's cash value can be used to cover premium payments. B. She can switch to a term life policy without paying premiums. C. The insurance company will automatically waive the premiums. D. The death benefit will decrease to cover the unpaid premiums. Answer A. The policy's cash value can be used to cover premium payments. Explanation. Universal life insurance policies have flexible premiums, meaning the policyholder can stop paying premiums if there is sufficient cash value. The insurance company will deduct the premium amounts from the policy's cash value to keep the policy active. Question 25. Which of the following life insurance products provides a flexible premium and a death benefit that can be adjusted by the policyholder? A. Term life insurance. B. Universal life insurance. C. Whole life insurance. D. Variable life insurance. Answer. B. Universal life insurance. Explanation. Universal life insurance allows for flexibility in both premium payments and the death benefit. Policyholders can adjust the death benefit and premium amounts based on the policy's performance and the accumulation of cash value, making it one of the more flexible types of life insurance. Question 26. Which of the following types of life insurance is typically the least expensive when first purchased? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Variable life insurance. Answer A. Term life insurance. Explanation. Term life insurance is generally the least expensive type of life insurance when first purchased because it provides coverage for a specific period, term, and does not build cash value. Premiums are based only on the cost of pure life insurance protection, making it more affordable than permanent policies like whole or universal life. Question 27. Scenario-based. MS. Rivera has a variable life insurance policy. She's concerned about market fluctuations affecting her policy. What can happen to her policy's cash value if her investments perform poorly? A. The cash value may decrease if the underlying investments perform poorly. B. The death benefit will decrease automatically if the cash value drops. C. The insurance company will cover any losses in cash value. D. The cash value and death benefit are guaranteed regardless of investment performance. Answer A. The cash value may decrease if the underlying investments perform poorly. Explanation. In a variable life insurance policy, the cash value is tied to investment accounts such as stocks or bonds. If these investments perform poorly, the cash value may decrease, while the death benefit may have a guaranteed minimum. The cash value can fluctuate based on market performance. Question 28. Which of the following statements is true regarding life insurance policies with a waiver of premium rider? A. Premiums are waived if the policyholder becomes disabled and unable to work. B. Premiums are automatically reduced as the policyholder ages. C. Premiums are waived if the policyholder reaches a certain age. D. Premiums are waived if the policyholder's beneficiaries pass away. Answer A. Premiums are waived if the policyholder becomes disabled and unable to work. Explanation. A waiver of premium rider allows the policyholder to stop paying premiums if they become totally disabled and unable to work while keeping the policy in force. This rider provides financial relief during periods of disability without losing coverage. Question 29. Which of the following best describes the purpose of the incontestability clause in a life insurance policy? A. It prevents the insurance company from contesting a claim after the policy has been in force for a specified period. B. It allows the policyholder to contest any terms they disagree with. C. It provides a guaranteed death benefit regardless of when the policyholder dies. D. It guarantees the policy can be converted to a different type of life insurance. Answer A. It prevents the insurance company from contesting a claim after the policy has been in force for a specified period. Explanation: the incontestability clause states that after a life insurance policy has been in force for a certain period, typically 2 years, the insurer cannot contest or deny a claim based on misstatements made in the application. This protects the policyholder and beneficiaries from having a claim denied long after the policy was issued. Question 30, scenario-based. Mr. Brooks has a $500,000 life insurance policy. His policy contains a misstatement of age clause. If Mr. Brooks' age was misstated on the application and he passes away, what will the insurance company likely do? A. Deny the claim entirely. B. Pay the full death benefit regardless of the misstatement. C. Adjust the death benefit to the amount that the premiums would have purchased at his correct age. D. Require the beneficiaries to pay additional premiums before receiving the death benefit. Answer: C. Adjust the death benefit to the amount that the premiums would have purchased at his correct age. Explanation: if the insured's age is misstated on a life insurance application, the insurance company will adjust the death benefit to the amount the premiums would have bought at the correct age. This ensures that the policyholder or their beneficiaries receive a payout based on the correct risk factors.